Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. South Korea's economy is facing increasing challenges, from the impact of U.S. tariffs to escalating tensions in the Middle East. In May, exports turned negative for the first time in 4 months, with automobile exports to the U.S. dropping over 27%. At the same time, the global oil market is seeing volatility due to the Israel-Iran conflict. Domestically, inflation is rising, particularly in food prices, and the Fed's decision to hold interest rates steady adds another layer of complexity to the situation. On Within the Frame tonight, we explore how these factors are shaping Korea's economic future and what strategies may help navigate these turbulent times. For this, we invite Shin Se-don, professor of economics at Sookmyung Women's University, in the show with us. Welcome, Professor.
My pleasure.
And also joining us from Texas is Hwa-kyun Kim, professor of banking and finance at Texas A&M University's Mays Business School. Good to see you, Professor.
Pleasure being here.
So let's begin our discussion with Professor Shin. Due to the fallout from the U.S. imposed tariff shock, Korea's exports in May declined for the first time in 4 months. In particular, exports of automobiles, which is a key export item, of course, plummeted over 27% to the U.S. in May. Do you expect export growth to decline further for the rest of the year, Professor?
Of course, of course. The total export for the month of May declined about 1.3%, first time in 4 months. But if you look at the export to the United States, it declined over 8% for the month of May, and it was almost 7% decline in the month of April. And we know that, the reciprocal tariff was imposed early April, and we are just starting to see the impact of Korean export to the United States. So we have to expect that further decline in the export, especially to the United States. And generally, the global economy has been cooling down, so that our exports to the rest of the world will decline over the course of 2025. So definitely, I believe that export performance for Korea, not just to the United States, but to the global market, would decline precipitously.
So we'll have to see if this declining export trend continues moving forward. Now, let's also touch upon another very important issue: bilateral South Korea-U.S. tariffs. Of course, they're set to take effect in just about 3 weeks or so. But the anticipated summit between the two leaders during the G7, which could have influenced tariff negotiations, has been canceled. Professor Kim, in light of this situation, what kind of strategy do you think the Korean government should be preparing?
Yeah, so it is unfortunate that the summit level talks got canceled because of this Israel-Iran situation, but still, most of the details anyway are made in the work group level. So I think it is important to focus on this. And when the Korea does this, what is really important is in the big picture level. Still, the biggest leverage I think the Korea has, is the free trade agreement, FTA, that South Korea has with the U.S. So at least as a benchmark, I think this should be the biggest leverage point that South Korea has to keep just talking, and also elevate this to the next level. So not just about like relieving the tax or just reducing the tariff rates. I think it should be viewed as more like a strategic alliance together with all the manufacturing, the goods and services, and how the complementary both countries' services and the goods are. Therefore, it's not about just the taxing one country over the other. So that way, I think the big picture level is going to be set better. That like details can be made in a much more favorable way at the end of the day.
So, with the summit off the table, Korea really needs to think ahead, and elevating the FTA to the next level would be a great choice. Now, meanwhile, Japan, already have engaged in 6 rounds of tariff negotiations with America, and a summit between the leaders already took place at the G7. But despite this, negotiations between the two sides still remained at a standstill. Professor Shin, from this, what kind of lessons do you think then that could South Korea draw out for its own talks with Washington?
Well, on the part of the United States, they want to make a deal very quick, especially against Japan and against most of Asian countries. But as far as I believe, Japan has a different attitude. Japan has not following a very in a hurry mode so far. So there has been a number of talks, and there hasn't been any conclusive agreement between the two countries, like the one between United States and United Kingdom. For Korea, I think the ruling government has been saying that we have to follow the pragmatic approach, which means that we don't have to hurry to make a deal. And also, President Lee has emphasized that he wants to follow the pragmatic approach on the one hand, and the second most important, issue is that he wants to keep the national interest. So, judging from pragmatic approach on the one hand and the national interest on the other, I think Korea will be following, the agreement with the United States, just like Japan. So it's going to take a long time. The unfortunate thing is, that we didn't have time to, talk on a summit level between President Lee and President Trump. But sooner or later, we're going to have a chance to, have to both leaders to have a chance to meet. But one thing that I want to emphasize is that United States are different, two different kind of attitude. As long as the reciprocal tariff, which means the United States wants to reduce the budget, the trade deficit, I think Korea has a lot of opportunity and a lot of ways to reduce trade surplus against the United States by buying more, petroleum from the United States, buying more from agricultural products. So I think Korea has a tool to reduce, trade surplus against the United States. On that part, I think we could reduce the reciprocal tariff, which is about 25% at the start. I think it could go down to 10%, or even, United States could emancipate the 10% reciprocal tariff. But as far as 232, Section 232 tariff, which is the national security tariff, that's a totally different, matter. So on the part of the United States, it's going to be very difficult to reduce, tariff, which is 50% on the steel, down to 25% or 10%. So for the steel, aluminum, the automotive parts, I think it's going to be very difficult to get a pragmatic deal with the United States. But on the other part, which is a reciprocal tariff, I think we have plenty of room to reduce that. So we have to follow two different kind of, tactics to deal with the United States.
So a two-track approach, one focusing on reducing America's trade deficit, would be helpful. Now let's shift our focus to international stage a little bit. Tensions between Israel and Iran have escalated, leading to increased Middle East risks and a sharp rise in global oil prices. Indeed, Professor Kim, given this situation, what is your outlook on oil price volatility moving forward?
So it's going to be high for the time being. So traders are definitely driving up 1 month implied volatility based on the oil futures or options on oil to 3-year highs. So that's a sign that the market is kind of bracing for this further spikes in some sense. So obviously this is coming from the worry or concern about the threats to the Strait of Hormuz, which handles about 20 to 30% of the global oil exports. So Iran's intermittent threats to close its have kind of spooked the market, and analysts warned that even a brief shutdown could push the Brent past like 100 and north of like $150 per barrel. So I think that escalates the volatility. Of course, the silver line, I think, is unlike the other periods, the global supply of oil is relatively plentiful. So that's going to work as a good balance. So if like price goes up, then I think lots of the oil supply will follow. Therefore, there will be some neutralizing movements. So that's a bit of a kind of nice part of like lowering the price again, which means that we'll actually see the big spikes because of the concerns, and then there will be a counterpart of like supply that's going to drive down the price. That means actually price is going to up and down a lot. So for the time being, as you mentioned, the oil supply and also the demand is going to increase the volatility for the time being.
A lot of fluctuation in the meantime. Now, on a related note, the U.S. Fed has recently decided to hold interest rates steady for the fourth consecutive time at the latest FOMC. Professor Kim, what are the key factors behind this decision, and what's your perspective on this latest decision?
So, obvious policy uncertainty or political uncertainty exists, and when there are political uncertainty or policy uncertainty, the Fed tends to freeze their rate or somewhat undecided about their rate. And this is somewhat reflective of this. So kind of like wait and see strategy. And we also see either in part because of this oil issues and also some other international tensions, the inflation expectations are still quite high and hovering. And the recent one, I think, is somewhat higher, like about 3%, somewhat higher compared to the previous one was around like 2.7%. So clearly, persistent inflation pressure still there to lower the interest rate, and also unlike last year or last quarter, the economic signals are somewhat more mixed. So all in all, I think the Fed is, instead of lowering the interest rate right now, let's just see what happens. And that's also seen in the FOMC meeting sentiments, according to the recent ones. I think looks like some of the Fed officials who were in favor of the lowering the rates. Now I think they just changed their stance, or they are somewhat stagnant in terms of like changing the interest rate actually.
So it looks as if they're staying cautious with the situation. Now, while the Fed has kept rates unchanged at the FOMC, it also indicated through its dot plot that two more rate cuts might be possible this year. Professor Shin, what do you think is the reason behind this outlook?
Well, it hasn't been changed. They expected last month that by the end of this year, federal funds rate will be 3.9%, and this time it is unchanged at 3.9%. So it seems that there hasn't been any change in expectation of the federal funds rate at the end of this year. But if you look at the components, you will see the very delicate change. Last time, there were about four FOMC member believe that the federal funds rate should stay at the current level. But this time, the number went up to 7. So generally, for the last month, generally FOMC member believe that they changed their expectation of federal funds rate at the end of this year, even though the average seems to be the same. So generally, I believe that 12 members of FOMC have raised their federal funds rate by the end of this year, which means that there is a strong possibility that there will be no change at all until the end of this year. That's what I read from SCP and dot plots.
Now, let's also touch upon, the Kospi, South Korea's Kospi, of course, with the Kospi breaking the 3,000-point mark during the trading for first time in 3 years and 5 months. Professor, how do you think the Middle East risks and the Fed's rate freeze would impact domestic stock markets?
Well, I think the Kospi went up over 3,000 for the first time in I think a number of years. But I think this is kind of the effect of a honeymoon period of the new government. The new government has set out a program to support the Korean economy, which is about 30 trillion wons, and that's a pretty big amount of money. So people believe that this government will be kind of pumping money to the economy on the one hand, and there will be promises the current president has made during his election that he wants to deregulate a lot of regulations concerning the stock market. So I think it is kind of a honeymoon period, boom in the stock market. Whether that's going to stay throughout the rest of the year, that I think is the challenging question. Not just to the government, but for the general investors in Korea. I'm pretty skeptical that 3,000 will be maintained or even go up throughout the rest of the year, because we have a very poor expectation in export, and there's a political kind of uncertainty surrounding Middle East, and we don't know how it evolves. So there are a lot of uncertainties and concerning kind of problems. So I'm pretty pessimistic about the future of stock prices going over and stay over 3,000 throughout the year.
So a strong Kospi is great, but global risk can change things fast. So we'll have to see how things unfold. Now, Professor Shin, in light of inflation pressure and economic slowdown, the ruling party and the government has reportedly prepared an extra budget totaling 35 trillion won, and discussions are also underway about further relief measures as well. Do you think these measures would help revive livelihood in the economy?
Yeah, definitely. 35 trillion won is decomposed into 20 trillion wons for supporting macroeconomy by giving kind of almost cashes to kind of pump up consumption. That's 20 trillion. Another 5 trillion is for small businesses to kind of get rid of non-performing debts, which is about which would have about $16 trillion effect. So that 25 trillion would be definitely positive for kind of supporting Korean macroeconomy and helping the people in their consumptions. And another part, which is 10 trillion won, is revenue readjustment, because so far, throughout 2025, our tax revenue has been lagging behind about 30 trillion. So expecting that, I think government has to change projections about the tax revenue. That's about 10 trillion. So that means 25 trillion won of macro supporting kind of expenditure and the 10 trillion won revenue readjustment, which is about the 35 trillion won. That I think it has to be financed by the bond printing. So the government has to issue a lot of the bonds, government bonds, and what I'm concerned about is what's going to be the effect upon the government bonds market throughout the rest of the world. But still, 35 trillion won is pretty significant amount to kind of supporting Korean economy, especially consumption.
Quite a bold measure by the new government.
Exactly. Yeah.
Now, South Korea's national competitiveness ranking, it has dropped by 7 spots from last year to 27th, and the presidential office has announced a coordinated cross-ministry response to recover the nation's competitiveness. Professor Kim, what do you think are the key factors for restoring the nation's competitiveness?
I looked at the rankings, the details, and this time I think the major reasons for this drop is not from the government side. It's probably from like the firm side. So the firms basically governance issues and their fiduciary duties to the shareholders, and also their R&D, and then willingness to take the risk and things like that have been decreasing. And that's kind of like why this, the rankings dropped a lot. In fact, like government part actually has been increasing. So I guess what the government wants to do is probably, as actually just now it's underway, just changing the commercial law and all these kind of things to the beef up, I think, the shareholder rights and then increase the fiduciary duties by the firms. And those kind of things would help actually just restore the rankings. And also, I think it is important for the firms to cope with big uncertainties now we are actually facing with, both in terms of like the political uncertainty as well as this new era of AIs and things like that. So that's gonna just change probably the next few years rankings if it matters.
So a strong coordinated response would be necessary to recover the nation's competitiveness moving forward. I'm afraid we'll have to conclude our discussion for tonight. Thank you so much for your time and for your insights, Professor Shin and Professor Kim. We appreciate it so much.
My pleasure.
My pleasure.
And that'll be all from us on Within the Frame. Be sure to tune in again next time as we continue to explore the stories that matter. Till then, stay informed and engaged.